Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets, and welcome back, Miles.
Call me Cotter.
Yes, call you Cotter.
I
You've
have
been gone for a while, and
it's
great to have the technical guru back here, and I know you've got a lot to talk about. You've been storing it up just as we get warmed up for the show here. Keep your seatbelts on. But without further ado, since it's been a while, let's jump right into some good charts, especially show us the downside. We want to talk about some key retracement levels, support levels in the precious metals, since that seems to be the direction that we're headed.
Sure. And one of my big arguments is the trend continues until morale improves, right? And arguably, gold is still in a bear market. Now, we're at the bottom end of our long-term trading range, so it has been trading down to this. We did get very close to a double tap around 1680, but the second one was a little higher. It was 1687, I believe, when I was gone here last week. And a little bit of retracement back up. I think we're in the low 1710 or so today. So we're bouncing around the bottom. And of course, the question is, do we see another reversal back up to 2100, or could we push lower? So because you asked, let's pretend we do push lower.
Okay.
And what some of those levels may end up looking like. Long term, we're still looking at the shallowest retracement level you would see. So 1687 is right around the 382 Fibonacci level. I would argue your next significant level down would actually be all the way down in the 1560s. So you could see some playing around between those two prices. And then your 618 fib would be around 1450, maybe a little under 1450. So there are some significant numbers that could be lower in gold if we do continue to push down below the 1687. So we are at a break point this week.
And you feel it subjectively, you see it objectively, but the hard part is keeping your pulse on all those underlying fundamentals. And I'm not going to sidetrack here right now and jumping into the fundamentals, because we know that gold reacts and it predicts. So to the upside and the downside, it's very predictive, as is silver. But that being said, with everything staying the course that we've been on, from an interest rate hike standpoint, from a recession standpoint, from a bond market standpoint, from a dollar strength standpoint, those are all fundamentals that are impacting that gold price. And really, there's not an end in the immediate future to any of those things. So that's why I'm asking this question. If we continue this course, what are these numbers? So I appreciate you pointing those out. I know you hate to predict timing, and that you won't predict timing. That's like predicting the news, if you will. But what do you see going on with silver if gold were to do that?
Silver's interesting because we've had a relative strength index oversold signal in the silver market. We've had 3 consecutive lower lows after we've already pushed into the oversold RSI level, and now we're starting to see RSI begin to climb, which usually indicates not necessarily a change in trend, but at least a short-term diversion from the trend. So that's why we call it RSI divergence. It's not RSI reversal. So I actually would expect to see silver, even if it puts in a slightly lower low here, I'd expect to see a bounce in silver. I'd also expect to see a bounce in gold. Now, the question is, how high do we have to get to argue reversal? I think your line in the sand for silver is about $20.90. I'd like to see silver get above that price. That would put us at a new higher high, at least in the short term. And gold is kind of similar. Anything above 1800, you could start to argue, okay, maybe we are going back up to the top end of the trading range.
In the meantime, the gold to silver ratio, as we talked last week, has gone up to mid-90s. So I think that if that continues to the downside, with silver's volatility, you have to expect that the gold-silver ratio will continue to climb as well. We saw 125 to 1 back in 2020 post-COVID shutdown, and that may be a real possibility, right? It screams buy silver here, but that doesn't mean we aren't going to go from 93 today to 113 by the time we actually hit the bottom. So you don't want to move your entire position just because of where the ratio is right now, in my opinion, if we see this continuation.
Right. The ratio back up in the 90s is obviously very enticing for anybody, especially people who are working with us with, say, ratio trading strategies within their precious metals markets. Now, you can't get from just checking the prices yourself, but you can get from talking with one of the advisors here, is you have the stated ETF, stated spot price ratio, but then you also have the actual product effective ratio, because we have to take into account something we've been talking about for years, and that's the cost of silver over and above the spot price right now. A couple weeks ago, even though the spot price ratio had been back up in the 70s into the 80s, when you talk to your ICA advisor, you'd see, well, realistically, you got to knock 10 or 15 points off of that because of the cost difference. Well, now that we're back up in the mid-90s, I checked the math before we came in here, and the effective ratio is about 80.
That's right.
So it's looking enticing again to be possibly diverting some of that money into 100-ounce silver bars for the sake of going into gold coins or gold bars at some point down the road.
Yeah,
so
even
I'm back on
thousands.
board. Exactly.
Yeah, I'm back on board too. And hundreds are a much better deal. 1,000-ounce bars are the best deal. Best way to avoid premiums. Unfortunately, you're talking about a roughly $22,000 commitment or somewhere in there. So not everybody can do the 1,000-ounce bars, but you're speaking exactly right. We have to avoid the premiums, and that means avoiding government-minted 1-ounce coins.
Right, and 100-ounce bars at $2,400 or so a piece is a lot easier to stomach and still fits the ratio play. So with all of these relative prices between gold and silver and kind of looking how the market's moving around and obviously feeling like, despite some of the concerns out in the market, why isn't gold going up better? I think it's time. As you're aware, I've been gone for a couple weeks. I have had something on my mind ever since a conversation I had right before I left. So I wanted to go back and look at some historical reference in the precious metals and overall market. And the reason I wanted to do this is because we are looking at, like you mentioned, rising interest rates. You know, this is the first rising interest rate environment we've been in since Greenspan, extended rising interest rate market. Now, I don't know if we'll get as high as Greenspan was able to before the 2008 market crash, but we are looking at an extended period where the expectation going forward is stronger dollar, higher interest rates. In fact, the dollar index, which is your comparison between the US dollar and a basket of the other major currencies around the world, is at the highest level since June of 2002.
Yeah, we just crossed 110.
Yeah, so we're looking 20 years. What a surprise. It's now, it's late summer 2022. And the last time we got there was 20 years ago, midsummer 2002. So what else has happened over the last 20 years, and how does that all compare? So I started looking at this, and I think it's about time we did something nobody else in the industry is going to do, and that's debunk what I would call the biggest lie in the precious metals market. Gold does not keep pace with inflation.
Let that sink in for a second.
Gold absolutely does not keep pace with inflation, depending on how you categorize inflation. So I'm just going to use, say, the M2 money supply because I think it's a very nice, long, broad range of how much currency is actually in circulation.
And we've talked a lot about that on this show.
Right. So I think it gives you, it's not the perfect example of categorizing inflation, but I think it gives you kind of a broad idea over the last 50, 60 years of how money in circulation has increased exponentially over time. So since 2002, the M2 money supply is up 280%. So if you're looking for something to keep pace with the M2 money supply, I would encourage looking at something like, say, silver, which is up 280%. Sometimes significantly more, sometimes less. And again,
Sure.
that's
but
why
where we are right now.
Right, where we are today.
Right on track with them too.
Yeah. The Dow Jones Industrial Average is also a great alternative to keep pace with inflation. Up a little bit less, 256% since June of 2002. So the Dow Industrial Average, your blue chip stock indicator. Now, granted, you also have to factor in any capital gains you've earned, so that kind of knocks a solid percentage off of that. But still not bad, keeping pace with inflation. U.S. oil, 214%. So U.S. oil has actually done a little bit better than inflation. Oil prices, at least the U.S. oil traded price on the market, a little bit less than inflation. Stated inflation back then was about 1.6%, got as high as I think 5.5% during the 2008 market crash. And again, that's stated. That's not how you and I would calculate
Correct.
it.
You got to double it.
But that's what the government tells us it is. And kind of varied between like 1.5% and 5%, staying closer to the 1 or 2 mark
with the
during
stated
most
objective
of that
of
time.
about 2.2. I mean,
Yeah.
2.3, that's where they want it to be.
Now, currently,
Showing
it's
their
about
cards.
8.5%
Right.
stated. So obviously, if that were to continue going forward, then all of these numbers would get ratcheted up, probably logarithmically. There are kind of some examples of things that can keep pace with inflation. Gold, on the other hand, up 440%.
So it doesn't keep track.
440%. No, so at least as far as the amount of money in circulation, gold is blowing it out of the water. In fact, not only that, all of that time, energy, effort you spend finding the right financial advisor or even just doing mutual funds over a long-term portfolio still does a fraction of what just owning gold coins in your basement does.
That's right. And that's the key, because think about that. It has that much room to give. If we see the downturn to these other Fibonacci support levels, that's still okay. You're still far outpacing just about any other asset class.
Yeah, that's a great point.
M2 money supply. However, those other categories, those other assets, the equities markets, if that's happening, those are coming down too. Because here's the underlying fundamentals to all this. Okay, one, you're encouraging me in terms of the gold ownership. You just always buy it. You buy it all the time. You cost average in, and you own it, and you compound ounces. That's just what we do, because that doesn't even take into account our compounding ounce strategies, which are going to be 150% even above that when taking that into account with getting up these free ounces. That being said, your interest rate hikes don't appear to be stopping. Recession equals employment issues. Interest rate hikes equals credit contraction and deflation in some assets. Energy issues. I listened to a podcast in December, and I went long energy because this guy had a very clear case as to why 2022 was going to be the year of energy. Man, that was an understatement. Look at how all these things are shaping up, especially in Europe. We have the luxury of almost being numb to it or making ourselves immune to it with our own energy supply. Not so in Europe. You're talking about major destruction of monthly budgets. We haven't seen anything yet here in the U.S. Retirees, to me, are at a major risk. Like, you better be prepared, because everything that we need to buy is being inflated. Everything that we already own is being deflated. And that's a bad combination when you're on a fixed budget. You're a retiree, and we see these things coming down the pike. I appreciate you pointing out the fact that the best protection has and will continue to come from gold, even if it's down 3 or 4% this year. It's a lot better than 24%.
Yeah, the only thing that's up as much as gold in the last 20 years is the U.S. national debt, from about 6 trillion to about 30 trillion.
It's disgusting.
Yeah,
That's
both are up
absolutely
450,
disgusting.
500%. That's it.
That's unbelievable. And again, in a really strong dollar environment. The last time the dollar was up 20% in a year was 2014. Remember what was going on with the gold price then. Go back to 2014. Remember, 12 it started, but in 13, 14, and 15, those were down years for gold because the dollar was doing great. And that was not that long ago. 8 years ago, we also saw the dollar index rally 20%. Well, guess what else? Bonds are down 20%. The 10 years at 3.5%. When was the last time that happened? 2014. So we have a really similar structure and makeup to the last time we saw a short-term bearish cycle or intermediate-term bearish cycle in gold. You started the program by saying the trend is bearish. In the macro long term, it still is not, but in the intermediate and the short terms, that's the trend you're speaking of that's bearish, and that's how it was 13, 14, and 15.
And one of the reasons why I'd be perfectly fine if that short-term trend continued, because let's say we go down to that next stopping point in the 1500s, you're still outperforming the Dow by 150%. The next one below that, in the 1450s, you're still outperforming the Dow by 120%.
That's right. You've got all of that cushion. That's assuming they don't follow gold down.
You have to go all the way down to sub $1,100 gold to match what the Dow Jones Industrial Average, that thing that signals the greatest investment opportunity in America
hedge against
Yeah.
inflation.
You have to drop all the way down. You have to give up every penny of gain that you've gotten in metals since the market bottom in 2015. Get rid of all of the gain over the last 7 years, and you're still doing just as well as the Dow does.
If the Dow stopped today.
Right where it is.
Right where it is.
Because if gold were to drop that significantly, especially off of some type of dollar increase or interest rate crisis or whatever, investments are going down with it too.
Yep. Sorry to be negative, but I do feel as if it's going to get ugly out there. Everything's sort of being shown in Europe. Like this is actually coming across the pond the other direction. We had ripple effects from the U.S. to the rest of the world in 2007, 8, 9. Now it appears with the whole Russia-Ukraine thing, adding issues, tensions, expenses, inflation, on top of the inflationary measures that COVID had already dealt the world. Well, now it's coming this way. And those European woes will have an impact. And that's part of the dollar strength. Europe's not really raising rates significantly. They've done one rate hike to speak of. Bank of Japan sitting at negative. China reducing rates. There's other countries that are in more desperate situations than we are right now, but it will impact us and it will have an effect. And I really do think that economically, the landscape is getting ready to change for the foreseeable future.
And with the price of gold outperforming the Dow by almost twofold over the last 20 years, with the stated rate of inflation at 2.5%, what happens over the next 5 or 10 or 20 years if the stated rate of inflation is 8 or 10 or 15? So that's going to do it this week for Golden Rule Radio. As always, we appreciate you stopping by. Do the YouTube things. Give us a call if you have any questions about your personal portfolio. We can be reached at 800-525-9556. You can also find us online at McIlvaney.com. We're on Twitter at ICA Gold or Facebook at McIlvaney Financial.
Thanks for listening. Have a great week.